Hey traders, welcome to Charts and Coffee. Great to have everyone here. Happy Thursday. Hope everyone's got a good game plan. If not, you're in the right place. If you have any questions, type them on in. Any symbols you're looking at, any questions you may have, let me know and we'll tackle them here in our Caffeinate and Dominate show. All right, so let's just get to the charts, right? I mean, we know what happened yesterday. There is right now a game of chicken happening. And it's really interesting to see. On one hand, Powell kind of really interestingly and blatantly said they don't see, I'm paraphrasing, because I don't remember his exact words, but essentially he said they don't see rate cuts this year. Well, when we head on over to the Fed Fund futures, which are actually very, very good about discounting what is expected in terms of FOMC rate cuts, rate hikes, what have you. There is an absolute liar, pants on fire trade going on. Not only are they factoring in potentially one more rate hike, but less so than I've seen in some time. Well, that's not true. I mean, take a look at what we have right now on the chart. What do these two columns mean? The 4 3/4 or 475 to 500 is a hold. 500 to 525 would represent a quarter point hike. In June, it's the same thing. Either we're still at 4 3/4 to 5%, 475 to 500, or we're at 500 to 5 1/4. So that quarter point hike is not necessarily factored in. But when you get out to September, all of a sudden, we are either holding or cutting. And it's looking very much like a cut. And this is the way I like to say the Fed Fund futures contract is not only a device, it's something we can look at to reflect what it is that the Federal Reserve is most likely to do, but it can also message to the Fed, this is what we're expecting you to do. And it starts to become a bit of an arm twisting device. Jerome, we're going to be really upset if this is not the outcome for this meeting. And believe me, the Federal Reserve knows what the expectations are. All right, so that's where we sit. All right, what else do we have? Let's jump on over to the charts. We have here the S&P holding. Now, I would not presume the S&P nor the Dow are going to be the relative outperformers as we go into today. And why not? Because they still have, and same thing goes with the Russell, by the way, the RTY futures, because they still have a good bit of financials in them. So financials are not out of the woods, gang. They're really not. And so the best way to navigate this market is not start to guess at where the low is in financials and not try to guess at, what other systemic risk there may be. There's really something interesting happening. I think we're all programmed to think that all these types of events like this regional banking crisis that reached over the pond, affected Credit Suisse, that these are systemic. And not to sound too brutal, but sometimes it's just stupid. Is it a small number of stupid banks doing stupid things, or is it really systemic? Right now, I'm going to say it's just kind of in the stupid category until proven otherwise. And just so do we have a number of traders who simply did not know what they were doing en masse within a single bank, right? I mean, an echo chambers is a thing. So if you have these echo chambers of let's buy these longer dated maturities at these ridiculously low rates and they're never going to go up and we're fine, that's pretty dumb. There's not a single person here at Simpler that was going to make that trade. Isn't that interesting? I remember that out there, this idea that they're so much smarter than we are, whoever they are, doesn't exist, right? So I was thinking about this. I was actually tweeting this morning, and this really summarizes kind of where I sit with this whole thought. And here it is. I don't trade like I know the future. We never do. My indicators don't lead. What a joke that is. I don't trade like a character in The Big Short. Michael Lewis is not going to be knocking on my door talking about some great big trade that I made, Michael Burry style. I try to avoid market talk that doesn't end with a trade idea. The market is a mystery book, gang, not a crime novel. Stop looking for the bad guy. Look for the opportunity. And gang, macro's no crystal ball. So let's be careful with where we are right now because it's really easy to kind of go into the groupthink, which is what I think happened to a small number of banks that, by the way, were not stress tested in the way that the big four are. Not that there may not be contagion. We just don't know. All right. So why not just go to where we do know there's very little financials waiting? That's why I keep harping on tech. All right. So with that in mind, let's go ahead and jump on over to the questions. I will step off the soapbox and let's get to it. All right. First up, Jack asks, good morning. Would I share my thoughts on the FedWatch tool after yesterday's FOMC and how it may affect equities? Yes, Jack, right now the FedWatch tool would largely be seen as more accommodative. They ignored completely what Jerome said, and it would be bullish. But again, let's avoid financials. Are we seeing resilience in tech, consumer, discretionary, communications, telecommunications? Can we see resilience in staples? Can we see resilience in utilities, which would arguably be those two, a defensive corner of the market? Can we see resilience in healthcare? Healthcare has been a dumpster fire. Could healthcare turn around? But tech, I would focus on tech for the most part. All right. So thank you for the question. All right. So next up, coming from our training room. And Anne, thank you very much. I had a good time doing that. We had that trader meeting yesterday. That was a great opportunity for me to pick the brains of many of our simpler traders and just get a feel for what some experienced traders, and I'm talking decades, right? I don't think there was a single trader on yesterday that was trading for less than 15 to 20 years. It's a really interesting way to say, hey, my experience predates 2007, 2008. And that's why it's so great. I love trading. And I was teasing Chris because I think Chris and probably Mary Ellen have been trading or, in the markets longer than I have anyway. And I was joking with Chris. I said, what did they do in 1921? Clearly you were trading back then. So we had a good time. I appreciate it. Thank you, Anne. You're very kind. All right. J cubed, Occidental. All right. So if we have Occidental weighted within a number of our energy corners of the market, I would really say two things. One, we're not going to see that acceleration effect. Now, this is classic slow stochastic analysis, gang. We've got a low at 20. We got a mid at 50. We got a high at 80. Now, you can make that low, 15. You can make the high 85. All that's kind of irrelevant. Just what's your low, mid, and high, right? That's number one with a slow stochastic. At the low, that's support and chop. As we cross the mid, that's acceleration. At the high, it's a ceiling. It's resistance. And right now, we're stuck below the mid, arguably lacking that bullish support or momentum. More coffee is needed, clearly. And therefore, I will wait for specifically J cubed. Let's get down to the slow stow low. Let's get down to the DPMR volatility support, and then I'll look for a buy. Now, on the flip side, if I get rejected at that mid, that 50%, where that's a bit of a level where on one hand, it's a ceiling, but if we cross through it, there's momentum. Again, very classic slow stochastic analysis. And if we get there and I'm close to the DPMR yellow zone, resistance zone, that might be another way to look at it. All right. Thank you so much for the question. All right, back on over to our Simpler Trading YouTube channel, as well as my YouTube channel at Raghee Horner. Good morning. Hey there, Jet Jockey. Yellen says, kapow. Yeah, Yellen and Jerome, Janet and Jerome had a little bit of a he said, she said. On one hand, Janet sort of undid a little bit of what Jerome had. And that was unusual to have the Treasury Secretary at the presser, but whatever. It was what it was. 1 hour. Thank you for the warning about large candles and Yellen still squawking. Yeah, Jet Jockey, that is definitely a time where we want to remember that sometimes it's just okay to say it's a do not trade time. I think there's a lot of power in knowing when not to trade and what not to trade. That's kind of for me right now, financials. And when not to trade, look, we have key players in monetary policy talking, right? Who knows what's going to happen? We saw a lot of that yesterday. So of course, my job and my pleasure. All right. Tony asks about the TQQQ. So any variation of the NASDAQ, any variation of it, to me, it's always going to start with what's happening with the NQ futures. So Tony, my thought is this is the one corner of the market, right? that is the most bullish. So whatever you want to do with the inverse, whatever you may want to do with the QQQ, whatever anyone may want to do with the micro, everything's going to start with the NQ. What's the path of least resistance? And so whether it's buy NQQ or short TQQQ, right? Whatever it is, let the NQ be the touchstone. Let that be the almost 24-hour look at what the NASDAQ is doing. And then whatever flavor of that you want to go with, choose your own adventure, right? Whichever way you want to go with that, as long as it's rooted in a firm understanding of what the NASDAQ futures are doing, I think the probability for a higher chance of follow through in the direction you're expecting is more likely. All right, so next up, hey there, pup. Hey there, pup. All right, so the dog has entered the building. Hey, pup, what's the matter? Hi. All right, so y'all can't see her, and she won't jump up on the desk. Hey, girl. All right, so let's go to the next question. And we have, let's see here. Let's see, Nomo FOMO, love the name. JP said reductions aren't likely, or words to that effect. Right. Who's right? These charts or JP? This is where the confusion starts, Nomo FOMO, because on one hand, Jerome Powell and the Federal Reserve, right? J Powell, Kapow, whatever we want to call him, he is the one making the decisions. He's the only one that officially can speak on behalf of the FOMC. Everyone else can express their opinion. He really is the mouthpiece, if you will. And who's going to be right? The data is going to be right. The data is going to be right. So what we're going to look at is are the jobs, inflation numbers, PCE, CPI, JOLTS, non-farm payroll, initial claims, GDP. Primarily, those are the three macroeconomic pillars. When we throw around words like macro, what we're really looking at is what is the rate of change of those particular points of the economy that the Federal Reserve is looking at to make monetary policy. Anything else is just dinner talk, cocktail talk, water cooler talk, right? What are the things that the Federal Reserve is looking at? And it's primarily inflation, jobs, and growth. And I'd say in that order. And then how is that going to basically guide their messaging and their monetary policy? So I would say the data is always going to be right. And it's the only thing that we can measure, right? So Nomo FOMO, great question. Always the data. And that means those particular data points, we watch them on a rate of change, which is just a fancy way of saying what's the trend in the data. And then they're gonna rely on that data to justify what they say and do next. So if the data is quote unquote good, right? In other words, unemployment is down, jobs are up, growth is steady, inflation is down, they're going to say we can continue to hike because we're not breaking the economy. That's a really good litmus test. Is that data saying the economy's broken or not, right? What is the Federal Reserve going to use that data to justify? If we have higher inflation, the Fed's got to stay on that case and keep hiking. If we have weaker jobs, the Federal Reserve can then say, ooh, okay, we've gone a little too far, and they'll walk back their messaging. And that's the way this game has been played, frankly, certainly in Powell's tenure, but for most of any Federal Reserve chair, they're usually data dependent. They're always going to say that. We just need to know which data they're looking at. All right. So next up from our YouTube room. Hey there, Prince. You were an amazing host on the annual call yesterday. We've had so many of these now, 3 or 4 of them. And yeah, it was fun. It was definitely fun to do. First time attendee, so cool seeing so many on one call. Felt like Marvel's Infinity War crossover event. Oh, so now we got to figure out who's who, right? We got to give everyone of the, oh gosh, that's hilarious. That's awesome, Prince. Thank you so much. Very kind of you. Thanks for tuning in. I hope it was helpful and maybe mildly entertaining even. All right, very cool. Meeting you hosted. Oh gosh, I do. I appreciate that, Stacy. I do. Thank you very much, gang. Yeah, we take turns because the whole idea is for you all to get a feel for all of our traders here. Because the truth of the matter is, it's kind of like a boy band, right? You may like simpler because, well, hopefully we make some good music. But then everyone's got their favorite, right? I'm going to date myself. The boy band when I was growing up, middle school, Duran, right? It's 5 guys. Everyone had their favorite. Mine was John Taylor, right? Everyone had their favorite. Some like Simon, some like Roger, right? So that's the thing. Until the band should make great music, and I sure think we do. And then you're going to have your favorite, right? You're going to have your Simon Le Bon in there somewhere. All right. Okay, but I appreciate that, Stacy. Okay, so next up is thoughts on Amazon. Hey there, Ryan. Yeah, let's take a look at AMZN. And both on a 1 hour and on a daily. That 1 to 3 day update video that I did last Tuesday, not this past Tuesday, but the prior, is still where I'm looking at my time horizon for trades, which is ideally suited to the 1 hour time frame. If we can get a move to the DPMR, I could buy. I don't have a trend any longer. So Ryan, while we did have a mean reversion at the open that took us from basically 99.5 to almost 102, that area, that was a mean reversion. Now the trend has transitioned to chop right back to slow stow. Right there's our low, by the way. So if you're wondering, what did Amazon do? Now I've got to focus on oversold buys, or let's see where our DPMR is sitting, and maybe we can buy into some volatility support. Thanks so much. All right, next up is Shop. Sure, taking a look at Shop. So Shop already did kind of what I was just mentioning to Ryan that I'd like to see Amazon do. Take a look at the 1 hour chart. Take a look at the daily, what we're looking for. And remember, I do have extended hours on my charts. I do have extended hours. But what I'm looking for is, and that's 3 p.m. right here. That's the 3 o'clock candle. That's what I'm looking for, right? That's what I'm looking for. That's bullish to neutral, oversold, already hit the DPMR support, which is the gray zone. And that's the kind of setup that I'm looking for. So that we're already off that level. So do I see a breakout? A breakout for me, Chris, is when the markets are compressed. They're stuck in a range. And from that range, we break out through the resistance. So it'd be a channel, maybe a Darvis, very narrow Darvis, maybe a squeeze, that kind of thing, right? And then once we kind of hit that tripwire price, which is usually going to have a number of buy stops, volume, either there or already have been there, either order flow or maybe a point of control. And then we see that movement through that level. What I'm talking about here is more of an exhaustion, right? But we're still both, I think, on the same page, which is long. I'm going to buy at support more often than I'm going to buy through resistance. That's the difference between exhaustion and momentum or breakout, right? But I think we're on the same side of that. I'm with you. Does ZB follow equities or vice versa? Hey there, Sergio. I guess, chicken or the egg, right? Generally, I would say, and nothing is always, right? Correlations are not fixed. They're not always the same, right? They're not always going to hold steady. The only correlation that's going to hold steady for all time is the euro and the US dollar. Everything else can actually really change quite a bit in correlation, because that's what we're talking about here, right? So my thought is, most of the time, yields are going to, I hate the word lead, but yields are going to usually go first, right? What we think is going to happen with yields then trickles down to equities, right? So most of the time, is money cheap or not? Are bonds something we want to buy or not? Are yields up or down or not? That will trickle down then to equities. However, when there's an issue like we had with Silicon Valley Bank, and now people are freaked out and they're hitting the panic button. The panic button is a giant button that reads bonds, right? So that's where news can affect bonds. And then some might say, well, Rog, did the sell-off in stocks affect bonds? Again, it's chicken or egg. As long as you know the relationship is usually going to be bonds communicating what's happening with yields and stocks reacting to that. That's the way that I look at that. And by the way, historically, gang, the idea that bonds and equities are inverse is actually incorrect. For the most part, indices, equities like cheap money. That's not unusual. if yields are low enough where it makes sense to not buy bonds, it could be junk, it could be high yield corporate, it could be notes, it could be whatever. We start and we start to look at what is the yield, almost like a carry trade. What is the yield if I buy this thing, right? Versus what is the possible return if I buy equities and I'm more speculative looking for more return, right? So I always look at that competition of that's what money's always doing. Where can I park my money for the best return? When yields are very, very low, like they were for so long, realize that monetary policy, like a German shepherd, is herding us into equities because there's nowhere else really to be. When yields are so low, there's no carry trade in the forex, right? So we ask ourselves, where are we sort of being funneled to? And for a long time, because of very, very low interest rates, we were funneled right into equities. And we saw the rally we've seen since, frankly, '08. So that's my take on that, gang. All right, as always, thank you for being here for Charts and Coffee. I will see you all tomorrow, same time, same station. My futures folks, my mastery folks, I'll see you in just a minute. All right, gang, be good to each other.